Measuring the odds of this is our market measure sponsored by Cboe. Measuring the odds of large daily moves in high volatility stocks. Measuring the odds of large daily moves in high volatility stocks. Let's go to the
sponsored by the CBOE.
Let's go to the first slide. In this segment, we delve into the dynamics of major market shifts in an effort to uncover patterns in their occurrence. Specifically, we aim to answer two critical questions. All right, Pat, here are your questions.
Ready. How
likely are significant market moves to happen within a defined time frame? And how can we quantify the major ETFs and liquid single stocks? By analyzing past events of similar magnitude, we can assess the probability of such shifts taking place again. Think they happen often? Not too often? Major market moves, obviously more so in stocks than ETFs. Obviously,
individual stocks, sure.
Individual stocks.
Yeah, it's harder to move 500 stocks or outside than it is for one stock, sure.
How likely are they going to happen? Because you know why we're answering this question. You know why we're posting.
Because we don't want it to happen. We play the don't line.
Exactly. The reason we ask this question is because this is not good for business. So let's go next slide. So we used two ETFs, the SPY and the Qs, and we used two stocks, Tesla and Nvidia. The reason we chose Tesla and Nvidia is because those are the two most liquid of optionable stocks. Those are the two most liquid. Of the ETFs, SPY and the Qs are the two most liquid of optionable ETFs. We did 2015 to present, 10 years. We calculated the probabilities of having a certain number of 1%, 3%, 5%, 7%, and 10% daily moves in a 5-day trading window. Okay, you got that?
Yep.
1, 3, 5, 7, and 10 in 5 days.
Okay.
Next slide, please.
I can't guess. I mean,
No. On the four most active option trading vehicles. Okay. So the first one, we start with SPY. The likelihood of experiencing from 4 to 5 days a 7 or 10% movement within a single week has been 0 for the last 10 years in the SPY. However, the probability of encountering at least one movement of 1% or more in a week is relatively high. Additionally, the SPY has an average daily movement of 1.11%. So
I mean, if you're going to have, it's going to happen almost every day, if you're going to say that, right?
Well, let's take a look. We have the numbers right in front of you, right there.
Mm-hmm.
And a 1% move, and this is just happening. You can see the numbers happening once, 25%, twice, 18%, 3 times, just across the board.
So what are you worried about? It's really what it's saying here. What are you worried about?
Exactly. I mean, but don't jump right to the punchline. Have a little fun with this. So the chances of having a 10% move, I mean, you can see or a 7% move, we're in the zero handle. And, 1, 3, 5, we put all the numbers in front of you. The chances of big moves are relatively small.
Mm-hmm.
But when they happen, they're very, very painful.
Yep.
Relatively small, very, very painful. Let's go next slide. Similar to the SPY, the Qs have also shown a 0% likelihood of experiencing a 5, 7, or 10% move in a single week. Looking at the past 10 years, the Qs have an average daily movement of 1.37 compared to 1.11 for SPY. And you can see the numbers across the board here. They look very similar.
Mm-hmm.
Would be difficult to differentiate between the Qs and the SPYs. But the numbers look kind of pretty basic, pretty much across the board the same. My takeaway from this would be the same thing. If, understand nobody looks for a 10% move.
Of course.
I mean,
nobody plays for it.
In the S&Ps, a 10% move in the S&Ps would be 6,000 points.
Mm-hmm.
That's a lot.
It's a lot.
Yeah.
Yeah.
So you're not going to see that. A 1% move 60 points.
We'd be closed. We'd be closed.
Oh, we'd be closed. We'd be shut down.
Mark circuit breakers.
Yep. Let's go next slide. Over a longer time frame, like 10 years, ETFs tend to remain stable, with the daily moves typically staying between 1 and 2%. In contrast, individual stocks like Tesla and Nvidia exhibit higher volatility, making significant price swings more frequent. So now we'll take a look. Let's go next slide, Beth. So as a highly liquid and volatile individual stock, Tesla, we expect to get more daily movement, with the average daily move around 4%. So the SPY 1.1, the Qs 1.37, and Tesla 4%. That's why it's so actively traded, because people love trading something that moves around.
And that's why they all have higher implied volatility, too, monthly implied volatility, than you're going to see in an individual stock, than you're going to see in an ETF.
The probability of experiencing 5%, 7%, and 10% movements within a single week still been 0 so far, but at least one movement of 1% or more per week is relatively high. Yeah, of course. And when you start to look at the numbers here, they're very different when you start talking about stocks that move 4% a day. But the prices also reflect that. So when you look at the amount of money that you make or have the potential to make, that's why Tony said this morning his best performing stock this year is Tesla. Yeah, because you can make more money in there. Or Nvidia or whatever else it is. Let's go to take a look at the next slide, which should be very similar in Nvidia. Nvidia has also shown a 0% likelihood of experiencing a 5, 7%, or 10% movement within a single week. And over the past 10 years, it's experienced an average daily movement of 3.5%, just under what Tesla has. And we played out all the numbers for you here so you can see. It's very interesting.
Yes, it is.
Just, you get paid over three times trading Nvidia over what you would in the SPYs, because that's how much more risk you're taking. You get paid 4 times in Tesla over the SPYs, because that's how much more risk you're taking. Let's go to the next slide. So there's very little probability of having a bunch of large moves back to back. According to our study over the past 10 years, individual stocks have exhibited more than 3 times the frequency of large daily movements compared to ETFs. And since early 2025, we've seen more large market movements compared to 24, offering profit opportunities to increase liquidity, but also posing risks like loss, distress, margin call slippage, and requiring strong risk management. This is all super interesting.